This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. It's the Wealth Roundup for the week of January 21st, 2026. I'm Terry Evans, along with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Patrick, our 30th episode today.
Oh my goodness. Wow. Just feels like we just started yesterday.
Yeah. But I'll tell you something, 30 episodes in, and I feel that I am much more savvy, of course, not nearly an expert, but much more savvy about so many things, wealth management and investment related. So I think it's been very eye-opening and a terrific opportunity. So
Terry, I was going to say the same thing just about this particular format. You know, thinking back to like when we first started, I call our very first podcast the pilot. You know, when people kind of joke about, I was once on a pilot. And I think back to that very first podcast and kind of where we are today. And it's great. You know, every single one feels, so much more comfortable and natural, and such just kind of a great way for you and I to have a conversation about the various topics that we cover off, and to be able to share this to the people that kind of tune in to listen. So I kind of look forward to the next 30 podcasts.
Yeah, and beyond.
And beyond. Yeah.
We'll see where we take it from here and how it continues to develop. The markets this week, anything that caught your eye?
Well, I think, one thing that was of note is the U.S. markets were closed yesterday for Martin Luther King Day. So there's a little bit of a kind of a catch up today. So we're taping this on Tuesday, January the 20th. So some of the, call it the events that happened over the weekend and even kind of Monday, they're kind of rolling into the markets today. Fairly significant decline in the S&P 500 over the past week, down about 2%. 2% doesn't sound like very much. But, if you had a 10% rate of return for the year, that's 20% of your rate of your return kind of right there. So I think a lot of this is just kind of getting caught up in geopolitical events as compared to, say, market events. Earnings so far have been good. We get Netflix today after market close. That'll be very important. Netflix would be one of those big Mag 7 stocks. So something to kind of keep an eye on there. I look at oil prices. Oil prices are at $60 on WTI. So really that's kind of unchanged. Gold continues to rise up. Again, up probably almost 3% year to date. Bitcoin is getting kind of taken out to the shed. Again, there was some very large redemption from some Bitcoin wallets that had been dormant for a very long period of time. So that's interesting. A couple $100 million US worth of Bitcoin that had been sold from a wallet that had never done a sale in 10 years, got sold. So that, obviously putting some downward pressure on Bitcoin. But just to go and talk about diversification. So we have the US market down 2% over the week. The TSX is flat over the same period of time. So when we talk about kind of a balanced portfolio, investing in US equities, Canadian equities, international equities, fixed income, cash, Canadian equities were actually a safe haven, over the last week. So when we kind of talk about the benefits of diversification certainly has kind of paid off. So we're going to see more earnings coming out this week. So we hopefully have more earnings to talk about next week. And then we'll see if some of this volatility in the U.S. market that has kind of started off this week, we'll see if some of that gets resolved. Perhaps calmer heads might prevail in Davos. Although I kind of feel like this is just, it was one of the risks that we had pointed out when we had talked about potential risks going into 2026. We had talked about policy risks, things coming up. So, tariffs obviously popping into the news again. So we'll obviously have to see where that takes us.
The Netflix thing that you brought up is especially interesting to me. It's to see what they end up doing. I know because here in Canada, the Spittin' Chicklets podcast is now available on Netflix, and they've done a bit of a shift to some high-profile podcast presentation on Netflix with a video aspect of it. So that'll be interesting. And as far as the Bitcoin thing, the $200 million that was cashed in, I finally found my wallet. It was in my other pants.
It was you, Terry. It was you.
Sorry about that. All right, let's get into the psychology of investing. I think it's interesting because one of the terms I suppose is well known, FOMO, fear of missing out. But then there's another one that we might touch on, and that's the fear of losing everything. So, did you make that up? Is that FOLAY, FOMO, and FOLAY?
I just wish I had thought of it first and patented it because it's got a nice ring to it. The FOMO trade, and so it's really wanted to talk about this today. Not because we had kind of anticipated we you might have a weaker period of time in the equity markets, but I think it's a bit of this trade has come out. I think this is my opinion. We've had some outperformance in the equity markets really since 2019. And what I mean by that is that the long-term average rate of return on U.S. equities is about, call it 11%, 10.5 to 11%. The US market specifically has averaged over 15% per year since 2019. Now that's significant outperformance. That's 50% more return on an average compounded basis for 5 years. And so naturally, I think that clients have this thing that, boy, if I don't get in now, I'm going to miss out on this opportunity. And when we kind of think about what leads to successful investing, I saw this great quote that it's about 10% math, 90% temperament in terms of successful investing. And so what is this temperament, as a description, it has a lot to do with individual behavior. What are you going to do as you are kind of forced to make decisions in an environment where you're getting all this input? You talked about this other term, this risk of losing everything. I think this is kind of another important thing, and I think people obviously they fear it more when there's negativity in the markets. When the markets are riding high, I think that's kind of the last thing that's on people's mind. I probably wouldn't be the first person to kind of say this as a statement, is that over our hundreds of thousands of years of human evolution, we've been trained to avoid risk. That's kind of what's allowed our species to survive. So we kind of manage, or our temperament kind of comes up from this idea of we want to kind of avoid risk. And then the other thing that I think is also a factor that is proven is that we feel losses at twice the amount of impact as compared to gains. Meaning, if we experience a $10 loss on a security, is that to have the same amount of equivalent emotion as we need a $20 gain on a security. So I think kind of managing all of these inputs and then acting on them. So our behavior has the ultimate net impact on what our outcome is going to be as investors. And so the good follow-up question would be how do we kind of manage this? If so much of this has to do with emotions and behavior, how do we take that and come up with some deliverables that we can act on in our portfolio to prevent us from making some big mistakes? And so, we've kind of talked about the benefits of, just a really good financial plan. And the financial plan identifies what I feel are an investor's true risks. And the true risks would be not being able to afford to pay your bills, not being able to afford retirement, maybe because your investments don't keep up to inflation or you haven't invested enough. So I think it's really identifying what's a real risk as compared to what we perceive as being a real risk. And then just also kind of knowing that our emotions and how we react to the investment decisions we've made is probably having more to do with our outcome than just being really good at picking stocks.
Do you find that people are more prone to be high risk and you have to, in your position, talk them down a little bit into something that is a little more sensible? Or are you finding that the psychological behavior of clients, you want to push a more little risk reward? Or is that even a question that you can answer?
So Terry, that's absolutely a real thing. This conversation in around risk and really the utility. I often use this kind of talking about the utility of your money. What do you need your money to do for you? How are you going to use this money in your life? And then, kind of expand the conversation beyond, what is, what's your tolerance for risk? I always think that's such a terrible question. Like how often in your life do you get asked, what's your tolerance for risk driving to work today? What's your tolerance for risk today going to go get groceries? It just, those aren't questions that people often get. And so I think people are in a really bad position to kind of answer that question. And then it doesn't help that the way that the investment industry often talks about risk as, your ability to manage volatility. Another really difficult thing for an investor, who's maybe working with an advisor or maybe somebody who's, managing money on their own to say, like, what kind of investor am I? Am I a high risk investor or am I a low risk investor? I think that we aren't answering the question. We're not gathering the correct amount of data to then go and act on it. And I think also we have to be aware of the situation and the timing when we're asking the client if, here we are, we've had 3 positive years in the market, pretty good years in the market. The last real kind of negative year for investing for clients was 2022. So asking clients kind of all the time about where they feel they are in terms of their investment plan and asking clients in terms of, is there any changes to your investment plan, your objectives, how you intend to use your money all the time? Because I do think that investors feel more comfortable having a higher percentage of their portfolio in growth equities when we've had a strong 3-year run as compared to, when we're maybe right in the middle of an extended down period in equities. Is that I think that people all of a sudden feel more hesitant about having higher portions of their portfolio in investments that can change in value significantly. So I think it's kind of doing these check-ins quite often on risk as compared to just check-ins quite often in terms of where's my account value today. I think that investors that look every day at their accounts versus investors that maybe only look quarterly at their investments are probably going to be able to assess themselves to say, what, my temperament kind of allows me to, invest and grow my money in equities more because I'm not looking at it every day, right? This kind of comes kind of full circle to that other, this great Warren Buffett quote, be fearful when others are greedy, be greedy when others are fearful. So true. It's so simple, but it's real. We see it all the time.
It's just like when you're trying to lose weight, don't weigh yourself every day.
Yes. Yeah, absolutely.
For more wealth management information and to start your investment journey, you can find Patrick's contact information at www.patrickmleonard.com. Thank you, Patrick. That wraps up the Wealth Roundup for the week of January 21st, 2026.
Terrific. Have a great week, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.